trust outperformed the FTSE All-Share during the quarter, and this was largely driven by our heavy positions in the resources sector, notably Thungela Resources, Diversified Energy and BP. All of these companies are producing significant cash flows, which these companies are using to hand back dividends to shareholders, do share buybacks in some cases, and also to invest in future growth. We believe that owning these companies is a win-win, both for our shareholders, because we can agitate for positive change that will deliver financial returns, but also because we as owners are active in engaging with these companies. So that can be a positive outcome for the wider world. Now, on the downside, we suffered from not owning Unilever, a defensive stock in a particularly anxious time for the wider world. We also suffered from owning Vistry, which is a house building stock. There were some worries towards the end of the quarter about the availability and cost of mortgages, which might slow down the volume of sales that house builders achieve. And finally, we also suffered from owning Randall and Quilter. This stock was bid for during the quarter, but that bid was narrowly voted against, which drove the shares down. We believe at this level that there is significant value in the shares. The latest quarter was characterized by intense fear that relates to the Ukraine war, the impact of the war on inflation, and rising interest rates. All of that fed to fears of weakening global economic growth. Now, during a period of fear, we see opportunities. And to put some names on that, within financials, we've been adding to Barclays, NatWest, and Hargreaves Lansdown. Rising interest rates, we believe, are unequivocally good news for these companies. And we are seeing that in the form of rising earnings forecasts, driving upgrades to dividend forecasts. So at the moment, we're seeing attractively valued stocks seeing these earnings upgrades, and we're taking advantage of that by buying more shares in those companies. Another one that fits that bill is TP ICAP, which is the world's largest interdealer broker. During the last 10 years, interest rates have been very flat at nigh on zero, and this has meant very little activity taking place in their core fixed income markets. All of that, of course, has changed in the last few months, and TP ICAP are responding to that with a significant upsurge in activity levels, driving their revenues. So this is good news for a company like TP ICAP, and we've been increasing our weighting. On the selling side, there's only really one stock to mention, which is Go Ahead. And Go Ahead received a bid from an Australian infrastructure consortium at a significant premium to its closing share price. We see this as an example of our process in action. We're looking for stocks where positive change in company fundamentals have not been recognised. And that certainly seems to have been the case with Go Ahead. Here's an operator that is perceived by an external bidder as far higher quality than its valuation in the listed market would imply. To answer this question, it's important to reiterate one of the key beliefs of this portfolio, which is that income and capital can go hand in hand. And what I mean by that is that if we find companies with upgrades to their earnings and cash flows, this can drive dividend growth. And that will typically allow these companies to be able to stand a very good chance of achieving share price appreciation. So the income and the capital can go hand in hand. And how we're seeing that playing out at the moment in terms of the portfolio is that we've structured the portfolio in such a way to provide us with three different categories. The first one is inflation protection, where we've found companies that will tend to do well in an inflationary environment. I've already covered some of these, so mining companies, oil companies, banks. This is where we've been adding exposure in the past 12 months, because these are companies where we are seeing the greatest benefits of this new market backdrop of rising inflation and rising interest rates. That's just over a third of the portfolio. We also have a category which we call mispriced yield. And these are companies which are paying a really attractive level of dividends, but the yield on those companies suggests that the market does not believe in the sustainability of those dividends. So these are companies typically with dividend yields of 7, 8, 9+%. We've had a good look at the business models. We think they're sustainable. So companies like Legal and General and Diversified Energy, which are perfectly good companies, which the market just has no faith that they can achieve those dividends going forward. We take the other view, and we see that as an opportunity. And the third basket of stocks we call latent growth, which is companies that operationally are in good shape, but which, due to worries about the cycle, about the turn down in the economy, are seeing falling share prices. So these are companies like One Savings Bank, Intermediate Capital. These are companies where we see good, strong growth further out, but short term, there will be worries about those companies. So by investing in companies like that now, we're able to take advantage, we believe, of that fear that is prevalent in markets right now. And the whole point here is to allow our shareholders to stand the very best opportunity to be able to take advantage of these particular circumstances which are caused by all these worries. And in my mind is this 21-year unbroken track record of dividend per share growth. I want to be able to come back at the time of the results and beyond that in future years and explain how by structuring the portfolio in this way, we've been able to maintain that track record of dividend growth.